Mortgage rates are way up, which is a big problem if you have a mortgage, but what if you rent? Do you really care? Well, yeah, because mortgage rates impact rental rates, so this is a problem for everyone, and we're going to discuss it with Ron Butler starting right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Ron Butler is the proprietor of Butler Mortgage. I got to ask him where he came up with the name Butler Mortgage. He is back making his 5th appearance on the Debt Free in 30 podcast. His last appearance was on show number 403 in May, and things are changing so fast that I had to call Ron up and say, hey, you got to come back on. So Ron, welcome back.
Happy to be here.
So the first 2 minutes of this show are going to be just about definitions. Okay, I want to make sure we're all on the same page, and then we can get into what's going on. So for my sophisticated listeners, you can just skip ahead 2 minutes. But here we go. Question number 1. What is a HELOC?
A HELOC is a home equity line of credit. It is a line of credit. Many people have personal lines of credit, but a home equity line of credit has been collateralized against your house, and it involves a minimum payment of the interest. Whatever interest is accumulated that month, it might be zero. You may never have used the home equity line of credit, but if you did, whatever interest accumulated that month is what the minimum payment is.
So the difference between a line of credit and a home equity line of credit is a home equity line of credit. A HELOC has security, your house. If you default on it and don't pay it, well, I guess they can take your house, whereas in an unsecured line of credit, there is nothing that they can take.
If you don't pay it for a long period of time, they will definitely take your house. There's no ifs, ands, or buts. Yeah.
So that's what a HELOC is. And the reason you're willing to put your house up as collateral is you get a lower interest rate than if you didn't put up your house as collateral. So it's a
100% correct.
Kind of a two-way street. Okay, so that's what a HELOC is. I know what a mortgage is. It's a loan that's secured by real estate. So I guess technically a HELOC is a subset of a mortgage. In a traditional mortgage, the kind, my parents had, your parents had, you pay a certain amount each month until it's paid off. So unlike a HELOC where the payment can go up and down based on, you can borrow against it, you can pay it down, whatever. With a traditional mortgage, you fix it, same payment every month. So what is the difference between these two words, term and amortization?
Sure. In Canada, the most popular term, whether it be for a fixed rate mortgage or a variable rate mortgage, is 5 years. It is by far the most popular term. So you start year 1, 5 years later, your mortgage is now up for renewal. That is the key phrase, up for renewal. And you will be offered a new rate, different rate, higher, lower, depending on the circumstances of the time. The amortization is the number of years the lender is offering to pay off the whole loan, whether it's 25 years, 20 years, 15 years, 30 years. That is the total length of time where we calculate your payment to get to a paid off mortgage at the end of 30 years or 25 or whatever you choose.
And what is the most common amortization period now?
Used to be 25 years, now it's 30 years.
And is there a maximum amortization period?
If you're getting a high ratio mortgage, that is a mortgage for typically a first-time home buyer who is putting 5, 10, 15% down, less than 20%, they have no choice. They must take 25 years. There is no longer mortgage term available. If you're putting 20% down or more, you can get a mortgage amortization of up to 30 years. So if we think about that 30-year mortgage amortization for a minute, in theory, you will have 6 different 5-year terms. 6 times you will renew and you will strike a new rate with the lender.
And that's the key to all this. So I've got a 25-year mortgage, but that does not mean the payment doesn't change for 25 years. The payment changes when the term is up, which could be 1 year, could be 5 years, whatever. And obviously in the interest rate environment we're in now, that becomes an issue. So, okay, you mentioned the term variable rate mortgage. So what is a variable rate mortgage?
In Canada, a variable rate mortgage is always tied to the Bank of Canada overnight rate. They sometimes call it the overnight rate, policy rate. When I was young, they called it an overnight rate. It is the rate set by the Bank of Canada. Now, you'd have to be like living in a cave not to know that in the last 6 months, the Bank of Canada has raised these rates several times, and sometimes a whole hell of a lot at once. So that is where all variable rate pricing rate is where it's all derived. It is the Bank of Canada.
And so the Bank of Canada rate has gone up, you're right, 300 basis points so far this year. We are recording this in September of 2022. They started raising in March. So 300 basis points is 3%, if you look at it in simple terms. Variable interest rates have not gone up by 3%, though, or have they?
Yeah, they have.
They have.
Absolutely,
okay.
They have. Yeah.
So a typical, let's say I was doing a 5-year term on a variable rate mortgage now. What am I, somewhere in the 5% range now?
Well, yes, because that is the overnight rate. The Bank of Canada rate is theoretically just a rate that the bank can only offer to federally regulated banks. So that is the rate the banks get from the government. Now, the bank has to add their own set of costs and profits on top of that. And typically that's 2.2%. So if you hear that there is a Bank of Canada rate of, say, 3%, then prime rate from the bank is 5.2.
Gotcha. And so I could have got a variable rate mortgage in January of this year if I had perfect credit, and let's say I put down a 30% down payment, something like that. I would have been getting a rate of something in the 2% or less range?
Definitely less, because historically in Canada, a variable rate mortgage, different than a HELOC, we'll touch on HELOCs a little later, but different than a HELOC, you will always get a discount on a variable rate mortgage. It might be small, and occasionally it has gone to zero. And on even more ridiculously rare occasions, it's gone on to Prime Plus. But in reality, you get a discount. So to simplify, if you got a mortgage, variable rate mortgage a year ago, Prime was 2.45 from the bank, and you got a 1% discount, the rate your payment was based on was 1.45. You got a 1% discount from 2.45. 1.45% was what your payment was based on.
So it was free money back then. And when you say prime, you're talking about the bank's prime rate.
The commercial bank's prime.
Commercial bank's
RBC
prime,
Scotia Prime, TD Prime,
right.
Yes.
Which is obviously higher than what the Bank of Canada base rate is. Okay,
correct.
So enough of the background. Now we get to the important question here. So what happens when interest rates go up? So with a fixed rate mortgage, a fixed term mortgage, pretty simple. I'm locked in for 5 years. So if I've still got 4 more years to run and the interest rates went up yesterday, I don't care. I'm paying the same rate till the end of my 5-year term. I don't really care.
You do not care. You
don't
care
care.
less.
Doesn't matter to me. But if I've got a variable rate mortgage, I assume I do care. Now, from what I understand, a HELOC is obviously it's a variable rate. My payment changes every single month. You tell me if I'm wrong on this. Whereas a variable rate mortgage, the interest rate is changing every month, but the payment is fixed up to a certain point. Am I close on that description?
You're in the ballpark. Let me break it down a little bit more. Those variable rate mortgages fall into 2 categories. There is a category which we refer to as static payment. In other words, the payment that is struck when your mortgage first is installed, when you first get the money, when the house is first bought, that payment stays the same. Prime rate will go up. The interest rate you're paying will go up, but you won't notice it in terms of a payment change. Now, just let me give you a sort of a backgrounder on that. Let's pick a number, a payment of $2,000. Back when your interest rate was 1.45 a year ago of $2,000 payment, 400 of that was going to interest, maybe 450, and the rest was going to principal. So 400 going to interest, 1,600 going to pay down your principal. You are paying your mortgage off $1,600 every month. Today, fast forward to today, That rate has gone up 300 basis points. It's now 4.45. And you're paying on that $2,000 payment. Now you're paying about $1,700 in interest and $300 of principals being paid down. What will happen, possibly in October, for some people it's happened already, possibly in October, if prime rate goes up again, your mortgage will actually start to grow. That $2,000 payment will no longer pay off all the interest. Your interest will be like $2,050, and your mortgage will grow $50 every month.
And is the bank going to allow that, the lender?
Well, the way it works is several banks actually do. Several banks say, well, we'll only adjust your payment when you exceed the original loan to value of your mortgage. In other words, if you put 20% down and you paid some off and now you're not paying some off anymore, your mortgage is actually growing, we will wait till you cross over the threshold of that 80% before we'll ask you any money, for any more money in payment. Again, saying all that, I want to point out that every bank, no matter what their process is, will tell you that you should probably increase your payment. As soon as you go into this world of your mortgage growing, they will all reach out to you and say, hey, your mortgage is growing, you should probably increase your payment. They won't necessarily force you. No, some banks will force you. Of the big 5 banks, one of them, and this is something we should all realize, one of them, your payment increases every time prime goes up. Every time prime goes up, you pay to make sure that your amortization stays the same. In other words, that if you said you were going to pay it off in 30 years, we're going to keep increasing the payment as prime has gone up to make sure that you will pay it off at 30 years.
Are you allowed to mention which bank that is on this podcast, or will that get you into a lot of trouble? Okay,
probably not. I got to do business with.
It's one of the 5 people. So
one of the big 5.
One of the big 5. Okay, so what you are describing there is a reverse mortgage. I mean, I realize it's not a reverse mortgage, but isn't that what it is?
It wasn't intentional. No. It was absolutely not intentional.
It's an unintentional reverse mortgage. So, yeah. And again, a reverse mortgage is something I get when I'm 70 years old. I want to take some money out of my house, but I don't want to sell it. I don't want to get a conventional mortgage. So the bank says, okay, we'll lend you up to, 50% of the value of your house. Here's the money. You never have to make any payments till you're dead. And so the mortgage keeps increasing. Obviously, the bank doesn't want it to increase by more than what the house is worth. And that's what you're describing here. So you said there's 2 kinds of variable rate mortgages, a static payment, which is what you just described. And I guess the other kind is what, an unstatic payment?
It's an adjustable, it's a payment that varies. So your payment is going to go up, a variable payment, your payment will go up each time that prime increases. It'll also go down when prime maybe someday goes down again. It will go down. The payment will go down.
And if we were to look back over the last, whatever period of time you want to pick, were most people getting fixed rate mortgages or variable rate mortgages?
It's very dependent on the rate cycle. For instance, when we were offering 5-year fixed rates for 1.59%, everybody said, to hell with it. Give me that 159 fixed. I mean, that literally is lower than the rate of inflation. I'm making money on my mortgage in reality. The inflation was 2% back then. So, 1.59, you might as well take out as much mortgage as you can get. I'm not recommending that, but I'm just saying in theory, when interest rates are below the rate of inflation, you're actually coming ahead. Now, what happened is that rates have gone straight to hell in a handbasket, and we're looking at very high rates. This is an 18-year high, both on fixed and variable. We have all types of rates, short-term, long-term, variable, HELOC, you name it. This is an 18-year high. So it's almost a generational increase in mortgage rates.
And the problem then is cash flow. So I got my mortgage and I bought my house in February of this year, right on the day the markets peaked. And I think the real estate markets in general in Ontario and most of Canada peaked somewhere around the middle of February. And my timing was horrible. I bought the house the condo, whatever it was, in the middle of February. And of course, the closing date was 2 or 3 months after that. And so the mortgage rate I'm paying might actually be higher than what I thought it was going to be. And if I bought it with a variable rate mortgage, my payment could be way higher today than what I thought it was going to be when I bought the house. I mean, it is not hard to imagine a scenario where I thought my payment was going to be $2,000 a month and now it's $4,000 a month. Is that a possibility?
It's likely that you thought your payment was going to, if you're one of the people with a variable rate mortgage where the payment increased each time prime went up. If you started at 2,000, you're probably at 2,750 today.
And that's only since March. So this is not,
Correct.
We're not talking 10 years here.
No.
And if we have another increase in October, which seems increasingly likely now, I don't know. I mean, you and I don't make predictions because we don't know the future. If we did, we'd be retired probably.
Very much.
But it's very possible that $2,000 you were paying could be $3,000.
Absolutely.
And
by the time rate hikes are finished, it could be a little over 3,000. Yes.
And that's a 50% increase in what you're paying on your mortgage. How many people got a 50% pay raise this year? I'm guessing not many.
It's not many, no, like maybe none.
Yeah, maybe none. And so that's the problem we've got. So the biggest expenses we humans typically have is for shelter, either the rent we're paying or the mortgage we're paying, and that is now spiked up considerably. And as I said in the opening, if you rent, then somebody owns the place you rent, and if that's somebody, you're renting a condo from somebody or a house from somebody, and they have a variable rate mortgage or a fixed rate mortgage that's coming up for renewal, well, their cost just went up too. Now, of course, your landlord can't just raise their rent as much as they want. There's rules surrounding that. But eventually this all filters into the rental market as well. That's why this is such an issue. Now, there's another issue I want to address with you. So I guess what we've just talked about then is the trigger rate. Is that what we were just talking about?
The trigger rate is the point where your mortgage grows. At that point where your mortgage grows, we refer to it as reverse amortization. But the reality is some banks are a little easier on it. Now, I'll give you an example. Some banks will say, look, you need to pay down your mortgage. Some of the big 5 banks will say you need to pay down your mortgage, but you don't need to keep that 25-year or 30-year amortization target in mind. We just have to make sure that you pay down a few bucks every month. That's the minimum we go to. So if those people, if they were at that point where they're at 2,700 and they finally skip over to 3,050 and it's $50, their mortgage is growing, the bank would say you just need to increase your payment by $60. But you are going to damn well do it. That's our rule. You must do it. So some of these, when we hear the term trigger rate or trigger point, in some cases, nothing is happening except your mortgage is growing and you're not required to pay more. But in some situations, you are required to pay more, but just not a huge amount.
So take a look at your mortgage documents or talk to your mortgage broker so you can understand what you got yourself into.
The good news about the big 5 banks is they all have portals that you can look at your mortgage that's in real time. And if you notice your amortization is what you thought was at 25 years has now gone to 54 years, you have an idea that you might need to call your bank.
And they will just do that without giving you a phone call and telling you that's what's happening.
When you reach the point that your mortgage is growing, they will all contact you directly by email, by phone, and by snail mail. In some way, they will contact you and hey, your mortgage is growing, dude. You have to give this some thought.
You got to do something. Okay. So back in the old days, like a year ago or 2 years ago, when house prices always went up and interest rates always went down, the best strategy was to lever yourself up as much as you could. Get as much mortgage as you possibly could because if prices always go up, interest rates always go down, so you can't possibly lose. So I go to the bank and the bank says, oh, no, your credit isn't good enough. We're not going to give you the 95% loan to value mortgage you want. And so I go, okay, I know what the answer is here. I'm going to go to a private lender. So I phone up my friendly neighborhood mortgage broker and I say, hey, Ron, you got any private lenders out there? And you go, yeah, sure. I know everybody. And so I get a private mortgage. And the way I do it, because I'm smart, you see, because I know everything always goes up, is I get a 1-year term because I know a year from now things will be better. So that's what I did a year ago. And of course, not a great strategy as it turns out, because interest rates are higher and real estate values are lower. So what's going to happen when I try to renew my mortgage with my private lender?
So in the case of private lender, the private lender, it's not just your idea that it should be a year. The private lender, by and large, 95% of the time is going to insist on 1 year. That's the way they like to do their business, 1-year terms. So what's going to happen for those who have a private mortgage? This is a mortgage not through a federally regulated alternative lender, because we have some of those too, but through just a private individual or a small company that is not regulated, that is simply doing private mortgages, and you got one and you had one, and it was a little high. It was like about 6% for a first mortgage, and you struggled and made those payments. There's two things that could happen. They're going to send you a notice that says, we want our money back. We are not offering any renewal. You need to give us the money back. You've got 30 days. Give us our money back. Go make whatever arrangements you can. Sell the house. Do whatever you want to do. But we insist on having our money back within 30 days. That's one possibility. The other possibility is, oh, yes, the 6% has gone to 11%. So your new payment will be X. That is the other possible thing that will happen with a private mortgage.
And are you seeing that happening?
Daily.
So how bad is it out there then? Like, are you getting people in, massive stress calling you? I mean, I realize people are always in stress when they're calling you or they're calling me, but is the stress level like through the roof now?
Yeah, I mean, a certain number of conversations always about the midpoint hit something like, I'm going to have to sell my house. Now, let's be reasonable though. It's only in Metro Toronto, probably only about 5 to 6% of all mortgages are private mortgages. Some of them are actually small, and I'm only talking about residential, not commercial. Some of them are not that big, and sometimes people can find a way to handle the repayment, or they can handle the 11%. Some people can't, and some people will find it. We're encountering right this minute the fact that some people are having true difficulty retiring or replacing the private mortgage that told them, we're not going to renew you. You have to pay us back. Yeah, it's happening. Now, it happened slowly. It only started probably in May, June is when it started happening. So it hasn't reached any sort of monumental level yet. We probably won't see the full effect of it until next year. Next year, we're going to be hearing more stories of people who were either forced to sell or were placed in some sort of foreclosure power of sale action by their private lender.
So we are witnessing a slow motion train wreck here.
Everything in the real estate business is pretty glacial, except mortgage rates and prices going down. We found out that can happen pretty quickly versus February of this year. Yes.
Right. And in my business, August was the first month in our history when the Hoyes Michaelis Homeowners Bankruptcy Index was 0, meaning 0% of our clients owned a home at the time they filed their bankruptcy or their consumer proposal. Now it's been in the sort of, 2% range for the last 2 or 3 years, because with real estate prices so high, if you owned a house while the equity went up, you can sell your house, pay off your unsecured debts. You don't need to call me. Back in 2011, it was around 1/3 of our clients, but the equity was so low, again, didn't really matter because we weren't in the crazy markets. So obviously the index can't go below 0. It will be trending higher from here. I am surprised that it was 0 in August and not a slightly higher number, because as you said, things started to happen in the spring of this year, but things happen slowly. So my prediction would be the same as what you said, which will be next year is going to be a lot different than this year, but tomorrow might not be hugely different than today. So your example of the guy with the private lender, hey, your interest rate's now 11%. Okay, well, I have no choice. So what do I do? Fine. I'll take the deal at 11% and I'll start drawing on my credit cards, my unsecured line of credit. I'll try to pick up a part-time job. I can live for a few extra months at that rate. And hopefully, by the spring, things have turned around and I can either refinance or sell my house or whatever. If things continue to deteriorate, though, then at some point I just hit the breaking point and that's where I'm at. So your guess then is these tough times have a ways to go yet.
Absolutely. You sort of taught me this on through a couple of your episodes. You pointed out that when CRA is not chasing people, when they pause in their chasing activity, there's a pause in your business. And when the CRA starts all over again, there's an uptick in your business. So to address the idea of what happened in August, I'm going to suggest to you that some people in June and July just stopped paying their mortgage because they couldn't afford to, or their private mortgage did not renew and they don't have any mortgage payment to make. So there's that sort of short period of time, that restricted period of time when you actually feel financially better off. You stop paying your mortgage, you know there's a sword hanging over your head, but you actually have more money every month because they wouldn't renew your mortgage, they're not taking any payments, and you have some more spare cash. Because the power of sale action, the foreclosure action, takes 4 to 6 months. So you don't really feel a panic. There's a lull and then there's true panic when process servers start showing up at your door. But that could take months.
Yeah, that is a very key point and very interesting point. So I already did hit the breaking point. I've stopped paying my mortgage. Now I'm living rent-free, mortgage-free because the bank doesn't kick me out of the house the first day. Maybe they kick me out in January or February of next year when the process goes through. And that's when then they're coming to talk to me. And even at that point, if the only debt you've got is a mortgage, which nobody only has a mortgage. If you have a mortgage, you have other debts as well. That's just the way it
Correct.
is. If you look at my clients, my typical client might have $50,000 worth of unsecured debt. But if you look at my clients who own a home, which at the moment is nobody, but historically, they would have perhaps $70,000 of unsecured debt. Because they own a home, they've got more ability to borrow. They've got more debt. So it's definitely going to catch up to them, but we're in this lull period now where, hey, I'm not making any payments. Everything is good. The other thing is, if I had a mortgage with one of the big banks and it was a CMHC guaranteed mortgage. So what does that mean? What does CMHC mean?
CMHC guaranteed mortgage means that when you stop paying, the bank files a claim with CMHC, or which is the government operation, or with Sagen, or with Canada Guarantee, who are two private enterprise operations that insure mortgages. So a claim is filed with them by the bank. The bank, if everything is in line, on the 90th day, every bank has to wait 90 days before they officially put you as a default on their books. In other words, if you miss the payments for the first 89 days, you're not technically in default. They don't show you as being in default, but on the 90th day they do. At that point, the claim would have been filed, and in some cases, the bank is paid off your mortgage shortly thereafter. They get the money to pay your mortgage off.
So this is interesting because that's not how I understood that it worked. I assumed that I stopped making my payment to ABC Bank, one of the big 5 banks, and the bank then has to go through the power of sale process, sell my house, and then if there's a shortfall, they go to CMHC to pick up the difference. Am I?
In some cases, some power of sale houses are sold by CMHC or Genworth or Canada Guarantee.
Gotcha. It could be either then. Okay. So,
or it could be the bank. It could be whatever arrangement they have.
Right. And if that's the case, I remember back 10 years ago, I would be doing a bankruptcy for someone and I would get a claim for CMHC for a house that had been sold. It was 10 years before that. was very common for it to take 5 to 10 years for a CMHC to finish all their accounting and paperwork and finally get around to pursuing the debtor by garnishing tax returns or whatever, which was when they then came to see me. So even if you stop paying your mortgage today, if the bank then gets paid out by CMHC, well, then it's going to be a long time before you hear from CMHC, I'm guessing. Like, it won't be the next day.
No. They're a little more efficient now.
Are they more efficient now?
Okay. You're definitely going to hear from them. Absolutely.
And, of course, if the bank's doing a power sale, well, of course, you're going to hear from them. I guess the main point, though, is, yeah, things are getting bad, but it is glacial. It's not,
it's delayed.
It's delayed.
It is severely delayed. Yes.
There is a significant time lag then. So, okay, well, so 2 final questions for you then. Do you have any, I already said we're not making predictions, but I'm going to ask you anyways. So what do you think the next 6 months look like? Do we have 1 or 2 more interest rate increases? Are we close to the end? Is it going to keep going, or is it impossible to say?
I would say this. I believe that when the Bank of Canada tells you good news, tells you things like, interest rates are going to be low for long, like they did 20 months ago, there's a chance they may be lying. It may not be low for too long. But when they look you in the eye and they tell you rates are going to go up until we break inflation, when they tell you something bad, they're probably telling the truth. And they probably will increase rates until they break inflation.
See, I assume they're lying. I assume they're lying all the time. That's my assumption. So the reason they give you the happy talk is we want everybody to be happy. But the reason they say we're going to keep raising rates forever is because what they're trying to do is get inflation down. And they can get inflation down by actually raising rates or by talking about it so that we all go, okay, they're going to raise rates. I'm going to stop buying houses. I'm going to, I'm going to, on the demand side, I'm going to stop buying stuff, and therefore we get a reduction in prices that way. So I don't know. I assume they're lying. Maybe lying is too strong a word, but they want to put public opinion where they want it to be. So, okay, but let's assume you're correct that when they say they're raising rates, they're going to raise rates, which obviously they've done, I think, 5 times already this year. How many more times do you think they have to do that? Or what is the thing that's going to make them stop raising rates?
Well, what's going to make them stop raising is a clear signaling of reduction in core inflation. They see core inflation going down. They could say, well, we're going to pause. So we're going to pause. We're not saying we're going to stop, but we're going to pause, and we're going to watch this to see if it continues down. If there's no change in core inflation, I won't bother everybody with the difference between core inflation and general inflation. But the reality is that if core inflation doesn't go down, chances are they're going to raise again in October, perhaps as much as 0.5%, perhaps as much as the 0.75% they raised last time. And in all likelihood, they will give Canada a Christmas present and not increase in over the Christmas timeframe, which is basically when the next meeting would be, the next announcement would be. But you can bet your boots they might come out with language that states after October, they may come out with language that clearly states we will keep increasing until core inflation starts to reverse.
Yeah.
Again, when core inflation does start to reverse, they have the opportunity to say, well, now we're going to wait and watch and see what happens. But until that happens, until core inflation starts to go backwards, they have a tough time defending leaving it alone.
Yeah, and you're talking about the Bank of Canada, who already did their September increase. We are recording this on September the 19th, 2020, the day of the Queen's funeral. That's why we're both dressed in, well, you got a black tie, I got a black shirt. I'm sure it was coincidence, but let's assume that's why it is that way. The Fed in the United States, I believe, has their announcement this week, which I guess will have already happened by the time this podcast airs on the weekend. You're talking about the Bank of Canada, which likely has, at least one more increase in the bag. So, okay, so final question.
I'll give you a date, October 26th.
October 26th. So at the end of October is when their next meeting is. And everyone would agree that, yes, they're going to raise again. Whether that's the last one or talk to us in December or January or February and we'll know for sure. So final question then, what kind of advice would you give your next door neighbor when you're having a glass of water out on the back deck there? Well, should I be buying a house or not buying a house? Should I be locking in or not locking in? Should I be going variable or fixed? What should I be doing? How do you frame that? What advice do you give people in general?
Well, if you don't need to buy a house right now, if you have no pressing requirement to buy a house right now, you should probably not buy a house. By the way, I'm not suggesting pressing requirements don't exist. I mean, they could exist. There could be job transfer, marriage breakdown. There could be lots of things that impact on your desire and need to buy a house. But in all likelihood, even though the precipitous fall in house prices has started to plateau, it's unlikely that if rates continue to go up, prices won't grind lower in most regions of Canada. So I say the same thing to everybody. Interest rates will change. They've gone up. They may go down. But the price you pay for the house is eternal. So if you have a chance to pay $50,000 less next year or $100,000 less next year, and you're not pressed to buy a house, why not pay $100,000 less?
Well, I guess the counter argument would be if interest rates are 500 basis points higher, then my monthly payment could be higher, even though I paid more for the house today. But I get your point. Once you've paid for the house, you paid for the house. That's it. The price doesn't change. So okay, if you don't have to move tomorrow, if you don't have to buy a house tomorrow, it will likely be cheaper in the future. And obviously, this show isn't financial advice. We're just two old guys talking here. And if the ideal dream home that you've always wanted comes up for sale, well, I guess you're going to do what you got to do. But having some cash in the bank now is not a bad thing, I guess, when interest rates are going up. Excellent.
Sure. And as far as fixed rates versus variable rates, I'll just be honest with you. There's not a whole lot of variable rates being sold right now. Today, the vast majority of people are taking fixed rates. Some people are choosing to take short-term fixed rates, 1 year, 2 year, 3 years. We're counting on the idea that eventually rates will come down, because you look at it this way. If these rates are an 18-year high, then there is a reasonable chance it won't reach a 30-year high. The rate will fluctuate. And if it's an 18-year high, there's a reasonable chance that rates will come down sometime in the next 3 years. And a short-term rate may allow you, I'm not a big believer in market timing, but I don't know if somebody should lock into a full 5 years at the highest rates in 18 years. There's a chance that you could take advantage of a 1 year, 2 year, or 3 year.
Gotcha. So the decision for a lot of people now isn't should I go fixed or variable, it's should I go short-term fixed or longer-term fixed. Should I go 1 year or 3 years? That's kind of the decision people are making. So, okay, that's also very interesting, and I think good food for thought for everybody. So, okay, Butler Mortgage, which I assume is named after you, or did your father start Butler Mortgage?
No,
it's you.
I'm the oldest guy in the operation.
There you go.
There's nobody.
Gee, that's kind of like Hoy's Michael.
My sons are involved in the operation. Let's call it a family business.
There you go. So Butler Mortgage, I'll put a link in the show notes. It's not hard to find. You go to Google and type in Butler Mortgage. You guys do a ton of residential stuff. And geography-wise, what area do you cover? The province, the country, whatever.
We're licensed in British Columbia, Alberta, and Ontario. Bulk of the business is Ontario, but we're licensed in those three provinces.
Got you. So if you need a mortgage, there you go. And you and I have dealt with at least one mutual client over the last few months who you were able to help out, and it was a difficult situation. So I know you can actually do it, and this is not a paid advertisement for Butler Mortgage. I wanted you on the show. There's no affiliate links or anything. I mean, if you want to pay me to come on the show, you can, Ron. But I'm happy.
Well, we're starting our own podcast.
Tell us about that then. So we're going
to start our own podcast. It's known as Angry Mortgage.
Angry Mortgage.
It's known as Angry Mortgage to suit my personality.
Mm-hmm. Yes.
And we guarantee there will be swearing and jokes, because we're going to go a little bit less sort of old-fashioned banking podcast and more sort of Joe Rogan podcast.
Wow, so fantastic. Angry Mortgage. And when is this going to debut?
Should be up and running by the end of October.
End of October. So you're kind of timing it with the next Bank of Canada rate hike. I like that. And so people can, when it's up and running, I'm sure you'll tweet it out. I'll put your Twitter handle in the show notes too. I think it's Ron Mortgage Guy or something.
Yep.
And because that'll be quite interesting. And so you're planning to do, is it going to be like a weekly thing?
It'll be a weekly. It's going to be about the same as you, about 30 minutes weekly. And that's our plan right now.
Cool. So everyone's going to want to listen to that. So there you go. You heard it here first. Angry Mortgage coming at the end of October with the jovialest guy we know, Ron Butler. Ron, thanks
for... There will be cursing.
There will be cursing. So, yeah, you'll have to put the not safe for work tag on it there so that you're not listening it in the office. Fantastic. Well, I'm looking forward to hearing that. And so it's going to be very topical then, obviously. It's like kind of here's what's happening this week. And is that what you're going for?
We're going to tackle some things that actually you guys have talked about, some of the general misunderstanding of the public about things like credit bureaus, some of the general misunderstanding about is some of these people who are advertising they're helping you refinancing your mortgage really helping you, or are they really hurting you? We're going to talk about a lot of things that you and Scott cover in many ways. That's
going to be fantastic. So there you go. Angry Mortgage coming at the end of October. Ron Butler, thanks very much for being here.
Thanks, Scott. Oh, sorry. Thanks.
Yeah.
Doug, I'm tweeting with Scott constantly, so it seeps into my thought process.
Yeah, I had to stop being on Twitter too much because it was seeping into my thought process too. I was becoming the angry trustee guy, so I had to ease off on it. But so there you go, Ron Butler. Thanks very much. That is our show for today. So in the show notes on YouTube, I will put links to everything we talked about, including Butler Mortgage. They got a great mortgage calculator, shows you all the rates. You can punch in how much it would cost, and I'll put links to Ron's previous shows as well. And then once the podcast Angry Mortgage is up and running, we'll certainly be tweeting that out as well. So if you are watching this on YouTube, hit all those like buttons, subscribe, notification, whatever, so you get notified every week when the new podcast comes out. Most people are listening to the audio version. It's available on all the podcasting platforms, Spotify and Apple Podcasts and Google and whatever else you listen to. So again, like and subscribe so you get the show every Saturday morning. There will be a new show next Saturday morning. Until then, thanks for listening. I'm Doug Hoyes. That was Debt Free in 30.